Today we're going to look at a stock that I've gotten a lot of requests to go over, which is Prospect Capital Corporation, ticker PSEC. They're a business development company that makes debt and equity investments in U.S. middle market companies. The company typically makes investments between $10 million and $500 million into each business across a wide range of different sectors. According to their website, their mission is to deliver consistent returns and preserve capital independent of market timing through a culture of transparency, collaboration, and alignment with investors. To date, Prospect Capital has paid out more than $3.8 billion worth of dividends to their shareholders. Just by looking at the surface, we can see there's a lot of things to like about this stock. It currently offers a dividend yield of 9.21% to investors, which is definitely above average for your typical dividend stock. On top of that, this company's been paying monthly dividends for more than a decade, and their stock currently is trading at a discount to its book value. It's also one of the oldest publicly listed BDCs, having been founded back in 2004. So with all these good aspects about PSEC, let's take a deeper look into Prospect Capital and try and determine if this stock is good for investors who are currently seeking income or maybe even some capital appreciation. For starters, business development companies by nature can be difficult investments to analyze because unfortunately there's often not a lot of information readily available. BDCs invest in small to medium-sized businesses that have a limited amount of public information available. So for example, if you go to Prospect Capital's website and look at their investment portfolio, you'll see a long list of companies that they're currently providing financing for. We can see one of their investments is in a company called 8th Avenue Food and Provisions. If we do a Google search, we can see that they have a website, but they don't publish financial information to the public like they would if they were a publicly listed company. We can't see things like an income statement or a balance sheet that would help us determine if this company is in a good, healthy position or not. So we really have no way of knowing how well 8th Avenue is actually performing. We can only make broad predictions, like if a BDC were to hold a lot of investments in hotel companies, we could predict that they might suffer a lot if we're about to go through a very serious recession. But even just looking up every single company on Prospect Capital's website and attempting to find performance information can be incredibly challenging and often near impossible if there's hardly any public information out there on the company. There's also a lack of information as to why a business development company might actually provide financing for one of these businesses over another. With a lot of BDCs, you basically just have to put your faith in the management team. That's why one of the most important parts of analyzing a BDC is to look at their track record. This is always the first step that I always take when looking at a BDC, because if the management team has been doing a great job in handling their debt portfolio, the share price and the dividend distribution should reflect that. BDCs are required to pay out 90% of their earnings to shareholders in the form of dividends, which doesn't leave them with a lot of room for growth. Because of this, it's ideal that a BDC should be able to at least maintain their financial performance or even better, grow it. But because of the 90% distribution law, it's really difficult for these kinds of companies to see any serious long-term growth. We can see by looking at Prospect Capital's share price performance since their IPO, it's lost over 40% of its value in the last 18 years. Coming out of the 2008 financial crisis, their share price was never able to even come close to fully recovering to what it used to be. For 10 years between 2007 and 2017, their stock share price continued on a downward trajectory, but the good news is that since 2017, it's basically flatlined. So if you happen to invest in this company after 2017, your investment probably hasn't changed much, but the good news is that you have been collecting some really high dividends, which is great. When we turn our attention to their distributions, we can also see some less than ideal performance. Over the last decade, this company has reduced their dividend 3 times. I mentioned this in a previous video, but the general rule that I like to follow for myself is if I see a dividend stock has cut its dividend more than 3 times in the last 10 years, that pretty much always kills any interest I have in owning it. So in terms of dividends, this stock is right on the border for me. I will say this though, both the share price and the dividends have remained stable since 2017. This could be a sign that management has basically gotten their act together, although it's no guarantee. To compare Prospect Capital with Ares Capital, we can see this stock also went through the 2008 financial crisis. But Ares' stock price was able to fully recover coming out of it, and they were able to grow back their dividends. So this shows that Ares Capital definitely has a superior management team behind them. But here's the crazy thing, because of that insanely high dividend yield, an investment into PSEC at their IPO would still leave you with a positive return. In fact, a $10,000 investment back on their first day of trading would now be worth $38,787.89 if you reinvested your dividends. That would leave you with an average annual return of 7.67%. It's not bad, there's other BDCs out there that would leave you with better results, but it's actually decent considering the dividend cuts and that 47% share price drop. That just shows how awesome high-yielding dividend investments can be. With that in mind, let's take a look at what Prospect Capital is like today. They have $7.7 billion in total assets and 128 different investments, and 71% of their portfolio is comprised of first lien and secured debt. 71% is much lower than average for a BDC, but it's still not bad, I'd say. But something that stood out to me was the fact that Prospect Capital invests in CLO equities. Collateralized loan obligations are securities that are basically pools of high-risk, high-yielding debt. Because they're pooled together, they're considered less risky because they're diversified, but historically speaking, these are not great investments. There are some companies out there that exclusively invest in CLOs, which I've talked about on this channel before, including Eagle Point Credit Company and OFS Credit Company. These stocks offer insanely high dividend yields, but their share prices get destroyed over time. Fortunately for PSEC though, only about 9% of their total portfolio appears to be in CLOs. Another thing that really stood out to me was their insider ownership percentage. For a business development company, it's pretty typical to see an insider ownership percentage between 1 and 3%. According to Wallmine, Ares Capital has an insider ownership percentage of 1.4%, Pennant Park Floating Rate has an insider ownership percentage of 2%, and Main Street Capital has an insider ownership of 4.8%, which is considered much higher than usual. But for Prospect Capital, they have an insider ownership percentage of 27.61%. What this means is the CEO and the board of directors have so much faith in Prospect Capital that they're spending millions of their own dollars to buy back shares of their own company. This is typically a really good sign and a huge plus for this stock in particular. Looking now at their investment portfolio, we can see a large portion of their investments are in real estate, which is something that I haven't seen for a BDC. Most of these companies invest in technology and science businesses, but Prospect Capital invests in multifamily properties as well. On their portfolio page, we can see that they invest in National Property REIT, which is a private, non-publicly traded real estate investment trust that holds multifamily, senior living, and dorm rooms. I don't think I've ever seen a BDC invest so much in real estate before, but I kind of like it. Multifamily properties typically have been really good investments if they're in good areas experiencing a lot of population growth. I feel like I should also mention an article that was written about Prospect Capital by the New York Times. A few years ago, they wrote a report which really criticized the management team and brought to light some really interesting facts about how they conduct their business. According to the 2015 article, despite Prospect stock free-falling for many years, the company continued to charge really high fees compared to BDC standards, and their CEO, which is John F. Barry III, was getting paid more than $100 million a year in compensation. This is another reason why BDCs can be difficult companies to analyze because they're not required to disclose how much a board is getting compensated on a yearly basis. Today, John F. Barry is still the CEO of Prospect Capital and has been since their IPO. To wrap things up, let's take a look at this company's book value. This is the most important financial number on a BDC's balance sheet in my opinion because a BDC stock share price almost always trades close to it. An increasing book value indicates a BDC has been doing a great job in managing their investments, whereas a falling book value indicates they've been making some pretty poor investment decisions. For Prospect Capital, we can see some pretty encouraging trends as of recently. For a long time, their book value was decreasing, but starting in 2020, there was actually some growth going on up until mid-2022. As of the last few quarters, it has been falling back down again, but that amount of growth was really encouraging, and I hope they'll be able to keep improving it going into 2023. With all that being said, my overall opinion on Prospect Capital has been pretty mixed. For the longest time, it has been turning me off from owning this stock for two reasons. For one, it went through a very long period of share price and book value declines as well as dividend cuts, which is something that I never like to see. Secondly, the management team at Prospect Capital has honestly been pretty greedy with all their fees and their exceptionally high compensation. I understand you could make the argument that this could be a good thing because since the board owns so many shares, they are motivated to exceptionally pay out high dividends to themselves, but at the same time, all this money could cause them to be more reckless with their management choices. But there's no denying that since 2017, the stock has actually been a pretty good performer for a BDC. With a flatlining share price but still good monthly dividends, it's been a pretty good pick for people wanting income over growth. But again, because of a lack of transparency, it's hard to know if the management team's actually been making improvements with how they operate. Have they been making improvements or have they gotten really lucky in the last few years? It's honestly really difficult to determine that. I'm not currently a shareholder of this stock at this point, and I have never been a shareholder of Prospect Capital, but I'm not completely against owning it. It's a stock that I've kept my eye on for years and years, but anytime I seriously start to consider it, I just look back at those dividend cuts and its declining share price value. Honestly, at this point, I've just been content on watching it, and I'm hoping that they can increase their book value as time goes on.